and welcome to another episode of the Wadhwani Viewpoint podcast. My name is Manali Shah, and today's conversation is going to be all about startups. Joining us is someone who's been on both sides of the table. Arjun Vaidya has been the founder of Dr. Vaidya's, a hugely successful Ayurvedic healthcare brand, which has since been acquired by the R.P. Sanjeev Goenka Group. Today, Arjun is a venture lead at Verlinvest, which invests in companies such as Sula, Epigamia, Veeba and Heads for Sale. So Arjun, welcome to the show and thank you so much for being here.
No, thank you so much for having me. I'm really happy to be part of this conversation. My name's Arjun Vaidya. Vaidya, my last name means Ayurvedic doctor. I come from a legacy of 150 years of Ayurveda. My grandfather and great grandfather and generations before all Ayurvedic doctors. And our business actually, Dr. Vaidya's was not a business. It was an Ayurvedic clinic that my grandfather ran. He cured me of asthma, and I made a promise to him that I'd do something with the family legacy. So I went to college in the US, saw the move towards yoga, and yoga become a multi-billion-dollar industry without Indian companies having much to do with it. I'm very patriotic. So I thought to myself, we can't let the same happen with Ayurveda. So I moved back to India in 2013, worked in finance for 3 years. And then when my grandfather passed in 2016, I quit my job to take on the family legacy of Ayurveda. In 4.5 years, I built India's largest Ayurveda brand online, went from 0 to 5,000 orders a day, got to 2 million transacting customers across 16,500 pin codes. Eventually launched 80 products, reached 500 plus cities, and then sold the business in March of last year to our Series A investors, RP Sanjeev Goenka Group. Since then, I've been pretty active on the investment side. So I'm an active angel investor, made more than 75 investments now. And professionally, I lead a VC fund. I lead the VC arm of Verlinvest in India, investing in the broad consumer space, so consumer brands, tech, enablers, and platforms. That's what I do. But as sort of passion, I really love the D2C and consumer products ecosystem. And so I give a lot of my time, effort, and energy to this ecosystem. I host India's largest podcast on D2C called Direct to a Billion Consumers. I have a cohort-based course on D2C. So I'm passionate about the space, about e-commerce, about consumer, and I do my best to give back.
Okay, that's been an incredible journey and it sets the perfect stage for the conversation to come. So let's just get straight to the questions. Now, just in 4 years of launching the brand Dr. Vaidya's, you managed to scale up so well. You've launched 80 products, you've had 2 million plus transacting customers. So what are the factors that go behind a rapid and successful scale up like that?
It's a great question. And I would say that I'll take you back to the journey of where we started and our failure, and then eventually what got us success, right? So Dr. Vaidya's, like most brands, started offline. And then we pivoted to online because we failed miserably offline. We launched in Bombay. We had 6 distributors. We put 10 lakhs of stock in the market. Eventually, we got all of this back. And we realized that we didn't know offline. There was too much competition and we had no right to win in this space, right? So we started off online. And the reason we started off online is because we realized that nobody was solving the Ayurveda problem online at scale. So that's what we set off to do. In November 2017, we launched our website. And in this online model, one thing I will say is my grandfather offered a free consultation in his clinic. And we decided to extend the same service online. So we offered a free consultation online. What we saw after a year is actually our customers were not only in Bombay, Delhi, Bangalore, Hyderabad, Chennai, and Calcutta. They were in Anantnag, Muzaffarnagar, Trichy, and Imphal, because nobody was offering these customers high quality Ayurvedic products and care at the touch of their fingertips. And that's something that as Dr. Vaidya's, we were able to give these customers, right? So I think it was that uniqueness of giving high quality Ayurvedic products and care using the power of digital at the touch of consumers' fingertips that allowed us really to differentiate and scale exponentially, because incremental value that nobody else was offering, and that gave us a differential mode that made us stand apart.
Right. So many things that you've mentioned right now are just, standing out to me. So if in terms of advice to other startups on certain aspects that you mentioned, for example, how would they go about with estimating the market size? What is your advice to them?
Look, I think on market size, actually, while I had a job in private equity in finance before I started Dr. Vedya's, I think the best way to test is to actually start, to put out samples, to give it to customers, to talk to customers. The great part about digital business is you actually can start small and see what happens, and you get enough data to see how customers are behaving and reacting, right? So my view on markets is whatever you read in newspapers and reports, put it to test and see what customers do. Rohan Mirchandani of Epigamia said a great thing on my podcast. He said, the moment customers take out rupees from their wallet and buy your product, that's the moment of truth for you.
Right, absolutely. He put it across so well. So, and in a similar vein, what about audience segmentation or audience profiling? How should a founder who's just starting out go about it?
You need to be something for someone and not everything for everyone. So I'm a big believer in brand and brand resonating to your consumer, right? Which means that there's that sort of customer profiling quadrant, which I suggest to all the people in my cohort-based course also to do, where you actually put what the space is, map out where the other brands are, and actually find the white space where you sit. You map out what your customer persona is to a very detailed degree. For example, not just gender or age, but likes, dislikes, other brands they consume, their problems in the market, what they do in their free time. And this white space identification plus audience segmentation or customer persona will actually help you be something for someone, because today customers want to buy brands they resonate with, right? We earlier bought brands for what, and we bought brands for how. Now we buy brands for why. And so that resonating of brand, that's really important.
True, true. And what would be your take on pricing strategy? How can a founder get that right? Because it's one of the crucial aspects of a successful startup.
That's a very tough one to generalize. But I would say if I was to just theorize it and speak more generally or theoretically, I would say that you got to test out what value your product is offering and what the customer is willing to pay for that, right? The pricing strategy for a product in India will be different from the US because the value ascribed to that product in India will be different from that of the US. So you got to deeply understand what value you're offering the customers and then decide from there.
Right. And if you don't mind, maybe you could then share your experience of building Dr. Vaidya's and what was the pricing strategy that you had in mind?
Yeah, look, at Dr. Vaidya's, we were a mass premium brand. So we weren't the cheapest brand in the market, but we weren't luxury. We always like to sit in the middle of the market. You do two types of pricing, right? One type of pricing was see where competition is, and then try to be in and around slightly lower, slightly higher. The other type of pricing was understand our costs and then understand our gross margin infrastructure. And as long as both fit, that means you made the relevant amount of margin, but you also sat near competition. These are the two things we kept in mind while determining price. So not the cheapest brand in the market, but not the most expensive. We like to sit in the middle.
When it comes to launching, there are so many factors, right? Getting the right time in the market and so on and so forth. What would be your suggestion on how founders can get the launch strategy correct?
At least for digital business, I would say when you think of launch, think of pilot first, testing out with customers, and then moving to large scale launch. That's the way I would look at it, because you're able to iterate on feedback before you go forward. That's the key for me.
Absolutely. So now let's talk about acquisition, right? In 2021, the RP Sanjeev Goenka Group acquired Dr. Vaidya's. What would be the right time for a startup to get acquired? Like, when do you think they're ready to go from, say bootstrap, getting funded, and then thinking, okay, now is the time to go for an acquisition?
Let me first step back a little bit, right? Because I get asked this question a lot. Don't build your business to sell or to get acquired. Build a good business. You'll get various options along the way, including funding, maybe IPO if you're really lucky, maybe acquisition, maybe strategic sale, partnerships, etc. All of that. Continue to build a good business. As you build a good business, you will get various options. Choose what option is right for you. Now, on the acquisition point, right, lots of people ask me, why did you exit when you exited? Was the right time? I think on these decisions, it's very founder dependent and very personality dependent. What's right for you at the time and what's right for the business at the time, both have to come together. It's not just what's right for the business, because there are people involved here, right? And so half my friends said you sold too early, half my friends said you put the perfect time. Who knows what the answer to that question is, right? I don't have the answer to that question. But what I will say is that it seemed right for me at the time. And so it's a very personal decision that only the founders know why they're taking.
Right, right. That is true. But when we talk about the key factors that go behind an acquisition or just an acquisition deal, what are the factors a founder should bear in mind while going in for such a deal?
I think first you got to think about why you're going into it. Number two, you got to think about you're making a very emotional decision to sell your company. So you got to also think about, which is not talked about enough, are they the right partners to take forward your legacy, and will it actually do justice? And for me, I did think it was that, right? So that's the second thing. And then the third thing is, from a timing perspective, is the right time for you to let go. If you keep these three things in mind, these are away from the legal and the numbers and the diligence and all of those things which everyone will talk about and which come more intuitively. I think from a sort of qualitative perspective, this is not talked about, but it's really important.
Right, absolutely. So now you've been on both sides of the table. You've been a founder, and now you're eventually at Verlinvest, which invests in brands such as Sula, Epigamia, Heads of Hotels, Veeba, etc. So now you're in a good position to talk about what investors look for. So firstly, what do VCs really look for in a pitch deck?
I'll tell you what I look for, right? I'm not just saying a pitch deck, because you look for much more than just a pitch deck, right? You look for a real business. So at the early stage where I usually invest, it's 50% founder. Who is this person? Will they fight through tough times? And does he or she have a right to win in this space, right? So that's on founder. For me, 50% of the decision is based on founder. Second thing is something we addressed earlier, which is market size, right? So how big is this market? Is it a niche market? Is it a large market? What's the competition? And how much of the market can this business look at? For me, that's 20%, because if you operating in a really small market that's not growing, then the business size will be limited. And you have to keep that in mind, right? So that's number two. And number three is obviously the business economics, right? So what's the sales, growth velocity, gross margin, structure, contribution margin, customer acquisition cost, repeat rates, EBITDA profile, path to profitability, and then obviously the team and the ability to scale, right? So it'll be 50% founder, 20% market size, and 30% business team and economics.
Okay, so when you say 50% founder, that's a lot.
But I'll tell you, that's at the early stage, right? Because these numbers will skew as you change your stages. For me, because I come in at the early stage, this is what I keep in mind.
Right. And how do you sort of gauge founders, tenacity, and those kind of softer skills? How do you get a sense of that?
Yeah, I guess you got to have multiple conversations and talk about things outside of work as well. It'll help you gauge a founder's personality, because at the end of the day, you're investing in a team and people. And so the team is as important as the business, at least when you come in an early stage.
Right. Could you give an example?
The business is nothing without the team, right? So
Absolutely. Maybe you could give an example of a chat you've had that really sealed the deal for you in terms of, yes, this is how I want to, take it forward with this person.
No, look, I think you gotta get to know a person outside of their business as well. So I think one of the investors that was meeting us actually said, look, we met in the office, we had a nice 2-hour chat. Let's meet over dinner now. Outside the work environment, outside the office. Let's talk about everything other than work, right? To see who you are as a person. Because look, it's not just one way, it's two ways as well. As a founder, if you take money from someone, it's a 5 to 7 year journey at minimum. You got to be able to have a conversation or lunch or dinner with the person once a month for 5 to 7 years. So it has to be a match in terms of personality. You got to gel. You got to be able to spend time together. Everything is not rosy in business, right? Everything isn't rosy. And so you got to be able to spend time with the person and reason through tough times as well.
Right. That's good perspective. It's like a commitment that you need to keep going for a fairly decent amount of time. So you might as well make sure that both parties are on the same page, right? This leads me to my next question. How and where should founders approach VCs or private investors?
Yeah, look, I think this is a $1 million question. I would say that you can use various platforms, LinkedIn, email, meet people at events, reach out to people, meet people through your common connections. I think all of these things can help. But I will say that past this, right, establish context for a connection, right? So I think if someone reaches out to me and says, "Hey, I know XYZ things about you, and that's why I'm reaching out to you because I think this opportunity is interesting," it's much better than just a generalized forward email, right? So I think that really helps, and that really sort of makes it easier because you would appreciate that investors also may get lots of deal flow and lots of inflow, and so they have to sift through a lot of information, right? So establishing context is something that definitely I recommend.
Right, right. And in terms of founders who are not based in, say, Bangalore, Mumbai, or Delhi, a lot of them often say that we don't have the same ecosystem that you guys do. What would be your advice to them in terms of reaching out to investors?
Uh, yeah, look, I'm actually very passionate about this space. Every time I get invited to a conference outside of the top 5 cities of India, I go, whether it's Indore or it's Chandigarh or it's Guwahati or it's Shillong. I've gone to all of these places and Surat and spoken at conferences and engaged with founders. Um, I think your location doesn't limit you from having a conversation. Your background doesn't limit you from having a conversation. It's much more a level playing field now. And so my sort of urge to all of these people is, look, India's a country with so much diversity, and everyone appreciates your diversity. So don't feel like just because you're not from Bombay or Delhi, it limits you from achieving success or building a scalable business. Not at all.
Okay. I'm sure this conversation has helped a lot of the founders that are tuning in. With that, we come to an end of this episode of the Wadhwani Viewpoint podcast with Arjun Vaidya, the founder of Dr. Vaidya's and now a venture lead at Verlinvest. We've spoken about scaling up, acquisitions, and what investors look for. I hope you enjoyed listening to this episode. My name is Manali Shah, and I'll see you in the next one.